Most people are familiar with Michael Burry as the main character in Paramount Pictures' The Big Short, a story of how Burry predicted the 2008 global financial crisis. And yes, I know, this is a clip of Christian Bale in The Dark Knight, not in The Big Short, but let's be honest, Burry is basically the economic version of Batman anyway. Nobody actually knows what he looks like, and every now and then he pops in with a tweet to save us all before deleting them and disappearing into the night. And that's exactly what Burry did just a few hours ago, posting a new series of tweets giving his insights on the economy. Today, I want to revisit some of the tweets from last year where he explicitly warned us about what is happening right now, as well as some of the tweets that he's posted over the past few weeks, including some that happened just a few hours ago. Oh, and if you enjoyed today's video, why not hit subscribe? It's completely free, and you'll also be helping me out. Get my silver play button when I hit 100,000 subscribers, because you totally care about that. Anyway, I want to start this video by talking about some of the tweets that Burry made last year, because I made a video last year going through some of these tweets, and I want to revisit them because he was spot on in terms of what we're seeing in the markets or have been seeing over the past few months and what we're likely going to see going forward over the next couple of years. One of the first key tweets was one where he said, "People always ask me what is going on in markets." He then said, "It's simple, the greatest speculative bubble of all time in all things by 2 orders of magnitude, #FlyingPigs360. And essentially what he was alluding to here is that in all aspects of financial markets, there was rampant speculation, much more than we've seen in a very, very long time, or maybe ever, right? And what he's talking about is speculation not just in some of the fringe areas of the financial markets, such as cryptocurrency or scam coins and altcoins, but broadly in cryptocurrency, and then also not only in scammy speculative stocks, but also broadly in stocks. There was many businesses that are amazing companies, amazing businesses producing a lot of profit, but even those stock prices, even those businesses had stock prices that were excessively high based on speculation. And even last year, it was relatively easy to reach the conclusion that it's at least possible that there's somewhat of a bubble going on in the stock market. The easiest place you could look for evidence of this would be something like the Shiller PE. Now, the Shiller PE is a relationship, it's a ratio between the average earnings of the S&P 500 businesses over the past 10 years divided by the price of those businesses. So essentially, it gives us a view of how expensive are stocks relative to the earnings on average they've produced over the past decade. And you can see that last year, the Shiller PE was at the second highest it's ever been. And even today, after the US market has come down a massive amount over the past couple of months, the Shiller PE is still at the same level as the peak of the Roaring 20s. Right before the Great Depression. We could also look at something like the normal S&P 500 PE ratio, which doesn't look at an average earnings over the past decade compared to price, but looks at earnings for the past 12 months compared to price. And if we look at that S&P 500 PE ratio, it is better, but it's still pretty bad, as you can see. Another tweet from last year said, "All hype speculation is doing is drawing in retail before the mother of all crashes. #FOMO parabolas don't resolve sideways when crypto falls from trillions or meme stocks fall from tens of billions. #Main Street losses will approach the size of countries. History ain't changed." And this is really Burry just saying that we shouldn't expect that when a bubble grows, that it's just going to ease out slowly and it's going to be this kind of sideways market while earnings catches up to speculative business prices. That typically does not happen, although technically it could happen. That typically doesn't happen. Typically, as he says, parabolas don't resolve sideways. They tend to drop off significantly in the bursting of a speculative bubble. And to be completely fair, that's exactly what we've seen over the first few months of this year. He also said the problem with crypto, as with most things, is leverage. If you don't know how much leverage is in crypto, you don't know anything about crypto, no matter how much else you think you know. And Michael Burry was bang on about crypto, and he was bang on about there being speculation and everything broadly coming down, but in particular cryptocurrency, many altcoins and scam coins that have been promoted by celebrities and other things ridiculously on social media for a long time. A lot of them absolutely got annihilated. You have even large cryptocurrencies like Luna Terra, which went to zero. And then you have Bitcoin, the shining star of cryptocurrency, which is down now almost 70%. So it's fair to say that Michael Burry's macro predictions, at least from last year, were pretty accurate. He's been pretty spot on. And not only has he been talking last year, he's been continuing to share his thoughts on the evolving evolving economic situation that we're seeing in the US and in many other markets. He's given a lot of discussion around what he thinks inflation will do, what he thinks the stock market will do, what he thinks cryptocurrency will do. So I want to zoom in and talk about some of the things that he's mentioned over the past few weeks. And then, as I mentioned, while I was planning out this video, there was a few more that came in just a couple hours ago. So I want to talk about those as well. So a couple of weeks ago, on the 13th of June, Burry said, "The theatre took more than a decade to overstuff. Not likely everyone gets out in less than a year." Now, Burry here is referring to the analogy that a lot of people use in a stock market crash, which is that it's kind of everyone trying to leave a theater or a cinema that's on fire, right? So everyone's kind of cramming towards the door, and there's one door, right? And there's this whole cinema that's trying to get out, so there's a bottleneck. And the other thing that's interesting about the stock market is it's not just about getting out of the theater through this tiny door. You also need to find someone to take your seat, right? You need to sell your shares to somebody, meaning you essentially need to find someone crazy enough to run into a burning theater and sit down while everybody is trying to leave. And the result of this can be devastating. We saw how quickly this kind of effect happened in 2020 when markets were down over 30% in just a couple of weeks as everybody tried to get out and nobody wanted to hold stocks, or at least very few people wanted to hold stocks. Burry alludes to in this tweet that he thinks that because the theater was being packed out for over a decade, that people were piling into stocks for so long, it's going to take a very, very long time for this to unwind. So he believes that this is going to go for longer than a year, very different to the 2020 crash, which was basically a flash crash that happened over the course of a couple of weeks. Also on June 13, he said, "Just getting one thing hard is right. 1999 tech bubble, 2001 to 2005 value revival, 2005 housing bubble, 2009 almond farms, 2020 COVID bottom, 2020 lockdown horrors, 2021 meme stocks, 2021 crypto leverage, 2021 inflation, 2022 not done yet, late 2022, question mark, question mark, question mark, question mark." Now, this is Burry just giving himself a big old pat on the back for being right on a number of things. And it is true. Burry does have a good track record of looking at patterns in the macroeconomic environment and seeing things that are coming. But the thing is, he's often very, very wrong with timing. And he had another tweet where he spoke about how he's always 1 to 2 years early or even longer than that. And that's the thing, right? That's really what we tend to see with even people who are good at making macroeconomic predictions. The timing of when economic events happen is impossible to determine. Someone like me, I personally don't take macroeconomic issues into my style of investing. I just look for businesses that can withstand short-term periods of pain and will come out the other side strong. But I do like learning about what is happening in the macro environment because it's interesting and there are patterns to look at. You can learn about things that have happened before, things that are repeating, things that happen in cycles, and really how the economic machine works, with the recognition that we don't use an understanding of how the machine works to predict what's going to happen and to trade based on that. I think that's a mistake. I think you can learn about it and observe as it happens, but the actual order of events and what happens to the economy and how that affects the stock market, these are things that are not predictable. Now, Burry might disagree with me on that, and that's completely fine. But personally, I don't think you need to really worry about macroeconomics. It's a very, very difficult field to be involved in. And it's very, very difficult to be right on a consistent basis. And you don't need to be. If you're in individual businesses, just find amazing companies that have the balance sheets to survive and the management teams to survive through short-term pain and have the competitive advantages to ensure that customers come back in higher volume, spending more money in the years after the economic problem has been resolved. And then this tweet was from a couple of days earlier on June 11th. He said, "Transitory? No. Peak? No. To the moon? If you mean a cold, dark place." The CPI news this morning was so awful that it changed the bond market's view of Fed trajectory, and the weakest sector broke. In bond jargon, MBS went no bid, no buys for the MBS. And this was the day that inflation figures were announced. And again, it was another record inflation rate in the United States. And Burry's taking a shot at the Federal Reserve, who has been consistently wrong for an extremely long period of time. And I personally think this is a well-deserved shot at the Federal Reserve. I've been saying this for a little while, that the Federal Reserve has just been sitting on their hands and kind of hoping that inflation goes away. And it is getting a little bit ridiculous to watch how slow they are to act, even though they've been so wrong about inflation for so long. And clearly what they're doing is not doing enough to slow down inflation, which is by far the biggest problem that is facing everyday people around the world, not just in America, but also people who are investing in markets. Funnily enough, a couple of days ago, I made a video talking about how the Fed needs to start doing 1% interest rate increases on the federal funds rate. And just yesterday, Jerome Powell announced that 1% interest rate increases are not off the table. So that was really good to hear. I'm so glad that they're now at least suggesting that they might do a 1% interest rate increase, because it's really what's going to be necessary, I think, in the end of the day, to get this level of inflation under control, the highest inflation we've seen in 40 years. And as I've spoken about, if you measure inflation the same way as we did during the previous inflation crisis in the 70s, then we're already above that. And back then they had to raise interest rates to 20% or 19%. So having interest rates where they are right now at 1.5%, I just don't think that's going to cut it. And then, as I mentioned, Michael Burry posted a number of tweets while I was planning this video just a couple of hours ago, so I want to go through these as well. Burry has not only been tweeting a lot about the economy, but also a lot about politics. And just a couple of hours ago, he tweeted about the ongoing Supreme Court decision that's happening in the US. And I'm not going to talk about this because I'm pretty sure YouTube will just delete my channel if I even mention what's happening in the US. It definitely falls under the category of controversial topics that I probably can't talk about, so we'll just leave that one to the side. All right, back to the finance tweets. He said, "Are we sure Bitcoin is not just another risk asset in the NASDAQ 100?" while showing a chart of Bitcoin's collapse and how it's pretty much identical to the NASDAQ, which is, of course, a makeup of US tech stocks. And this tweet, of course, is taking a direct shot at all of the crypto experts that seem to suggest up until the start of this year that Bitcoin may act as a safe haven against inflation, just like gold is where people rush when there's inflation. Even as the stock market collapses, typically gold does quite well. People suggested Bitcoin would do the same, but as we've seen, Bitcoin has just acted like every other risky asset in that it's collapsed like the stock market, and it's actually following alongside the at least partially speculative NASDAQ index. Another tweet he said here was, question, in 2022, what brings a Christmas in July? Answer, a disinflationary, overstocked consumer recession at Christmas. Disinflationary, which is different from deflationary, means a slowdown in inflation. So essentially where prices are still rising, so there's still inflation, but they're rising at a slower rate than they were previously. Now, I'm going to be honest here, I have absolutely no clue what this tweet means. If you have any shred of an idea of what this tweet means, leave a comment down below, and I'd love to see what are the different theories around what this could potentially mean. I mean, in the tweet, he says, what brings a Christmas in July? And the answer is a consumer recession at Christmas. So that seems to suggest that he's implying that 2021 Christmas was overstocked and a consumer recession causing something that's going to happen next month. But I don't know. Very, very cryptic. You need to be able to speak Michael Burry in order to figure out what the hell that means. And I just wanted to end on this final tweet where he said, knowing saves half the battle. Got it? It's not hard. Analyze, think independently, be informed, find the data, and you'll know a lot that no one else does. And I think that's a great sentiment to end this video on, because if you want to invest in individual businesses, if you're trying to outperform the market, do better than average, then you need to be an independent thinker. You need to be doing your own research and coming up with your own view of how individual businesses will function. And that may or may not take into account what you think will happen with macroeconomics. For me personally, I don't care what the macroeconomics will do. I'm looking for businesses that will thrive regardless of what is going on in the broad economy. If you're interested in seeing how I pick individual businesses, then I actually have a checklist that you can see all of the things that I look for in businesses, and I'll link it down in the description below. You can check it out. It's completely free. It's free, just like subscribing. So go ahead after this video, hit the like button, free, leave a comment, free, get my checklist, free, and hit subscribe, free. See you later, guys.